Morning, everybody, and you're all very welcome to our webinar this morning, our masterclass on investment fundamentals for startups and scale-ups. Thanks for joining us. Great to have a good crowd here on this sunny morning here in the sunny southeast. I'm going to begin when my laptop decides to play the game. To have a quick chat with you and tell you, before we get into the details of the masterclass with Siofra, to talk briefly about Southeast BIC. So Southeast BIC is a public-private partnership established in 1995. We're based here in Waterford. We cover the 5 counties of the Southeast. That's Waterford, Wexford, Carlow, Kilkenny and Tipperary. And we're very closely aligned to Enterprise Ireland and very involved in the fabric of the ecosystem of support for entrepreneurs and startups and scale-ups in the region, and that's our job, and that's what we do every day. We're part of the European initiative, the European BIC network, and there's 110 EU BICs around Europe with 40 associate members. So the job of the BICs is to push that regional sustainable economic development, very much in the startup space, very much in the access to finance and funding space, and very much around investment. And that's why we decided today to get working with Siofra again, who we were so delighted to have an event with in 2017 here in Waterford, and to offer that out a little bit more broadly this time in order for everybody else to get involved and have it as a webinar. So to understand where we fit within the startup ecosystem, most people will know the local enterprise offices are the first stop shop for any entrepreneur or startup. Also the New Frontiers programs, we've 2 great New Frontiers programs here in the Southeast in Carlow and Waterford. And then obviously the goal is to become a startup that scales, that internationalizes, and that has that ambitious growth plan. And we fit in the middle of those supports and the supports that Enterprise Ireland provide to those scaling startups. So it's very much around the funding journey, and the funding journey and the piece of the funding journey that we specialize in is around pre-seed and seed. So we support our clients through that process to help them to scale, but to help them to be correctly funded at the right time. So they're very much the supports that we give people, but very much living in the investor ready space and helping companies get investment. And one of the routes that we support companies to get investment is the Halo Business Angel Network that we run here in the Southeast. So the Halo Business Angel Network is a network of business angels, matching investors with high quality, pre-screened, early stage scalable companies. And we hope some of you guys are some of those potential companies. These are the kind of companies that have been supported since the beginning of the Halo Business Angel Network's establishment. So we work with Dublin BIC, who run HBAN, and then all the other BICs in the country run the regional elements of that, along with Clarendon Partners, who run it in Northern Ireland. So it is an all-island network. So once you get involved in HBAN, there is great opportunity to pitch to the angels here in CBAN, here in the Southeast, but also across the other networks and syndicates. So established in 2007, we've been working with our angels and our client companies across those years, offering really good quality deals and potential deals to those investors and angels. So if you're a potential investor, we'd love to hear from you, but mostly we're working with the companies. We support the companies in the process of getting them to the point of being investor ready. And working with Siofra today is really an important part of that, so that the companies understand how that process works, how the whole investment in seed particularly works, and the impact that it has on the founders and the long-term growth and viability of the business. So these are just to give you a feel of all the different syndicates. So it's not just here in the Southeast, there are a number of different groups and syndicates of individual angels all across the country who companies get access to throughout the HBAN process and throughout the HBAN network. And the type of companies, obviously there's a huge focus on ICT, and then obviously across everything else. But our angels are interested in a variety of projects. They're interested in lots of different risk. They're interested in lots of different sectors. So if you're a company, an early stage company who's interested in getting a seed round, we'd be really interested in having a chat with you. These companies have to be ambitious. Obviously, that's what angels and investors are looking for, is growth-oriented, ambitious companies, really, really clear in what you want to do, with a good promoter, a really good team, ideally, with credible management, a really good, strong business plan, but that's where we come in and can help, and are scalable and with potential, ideally, and international potential. So that's who we're looking for. If you fit the bill through and you're here in the Southeast, we'd love to hear from you. If you're in any other part of the country, we can refer you on to our colleagues in HBAN elsewhere and in all the other BICs. But that's the kind of companies that we're looking for to present in front of our angels. These are our details. We can throw that up again at the end so that you can catch them, or you can contact us on the chat. I know Siobhan is here on the chat, Siobhan, my colleague, so she can take anybody's details who wants to have a conversation. But this afternoon, I'm really delighted to introduce you all to Siofra Flood, who is the first legal counsel at Iona Technologies, is now General Counsel and Executive Advisor at Waterford's own Nearform. Many of you will know Nearform as the developer of the COVID app for many different governments over the last number of years. She has great experience of IPOs, acquisitions, seed and pre-seed funding with the likes of Drop Kitchen, Swerve, Iona, Havoc, and of course Nearform. So what she doesn't know about investment isn't really worth knowing. So I want to hand over to Siofra. She's going to bring us through a really, really interesting masterclass. I've experienced this before, and I think you're going to get great value out of it. Thanks, Siofra. It's great to have you here.
That's fantastic. Thanks a million, Rosemary, and welcome everybody to your masterclass, hour and a half, get to know everything about seed funding in one easy morning. So,
it's that simple.
Exactly. So I'm just going to share my screen, and we can start off. Rosemary, can you see that just as a sample?
I can. Yeah, perfect.
Okay, perfect. Okie dokie, I'm gonna dive right in. We don't have a lot of time, so we're like I say, I'm gonna hit the highlights. It's going to be kind of necessarily high level, but there's going to be some kind of meat on the bones as well. And I'm going to stop as well at various points. If you want to put questions into the chat, Siobhan will be keeping an eye on that. And if anybody, feel free to ask questions in the chat, and Siobhan or Rosemary can interrupt if the question is pertinent to what I'm talking about, particularly on a slide. So there's no stupid questions. That's very important to realize. I think that when people are at early stage, there can be, you can feel that there's a bit of an assumption that you should know all these things. And I don't see why you should know all these things at all. And there's certainly no shame in not knowing these things. People use a lot of jargon, and there's shortcut versions for everything that makes it sound like everybody else knows everything, but they don't. Trust me. I can absolutely testify to that. I had to learn all this when I started in Havoc. And that's one of the reasons that I developed this, was because I realized that there was an entire world of language, of accepted norms, of things like that I just wasn't aware of. And I myself had spent a lot of mental and emotional energy kind of railing against things that I probably didn't understand really. Whereas in reality, it's what's pertinent to know is what battles to pick, basically. So without further ado, from the get-go, if you have a founding team, or a co-founder, or are looking for a co-founder, or acquire a co-founder, it's important to align your goals in what you want. So this is from Noam Wasserman's Founder's Dilemma. And I can recommend that. There's a Harvard Business Review article that you can access. He's also written a book, which is big and wordy, but it's well worth it if you have the time to read it. But the point of this concept is that the decisions that you make in order to build value, by which he means accelerate value. So build value by taking positive step or deliberate steps in order to accelerate value. The decisions that you need to take in respect of your business in order to do that are in nearly all cases diametrically opposed to the ability to maintain control over the business. Now, we're not talking about extremes. We're not talking about like completely losing control of your business or anything like that. But if you look at it from a funding context, you go for funding in order to accelerate the development of your business, be it get funding to do more development or access more markets or invest more in marketing or sales or something like that, hire senior people. But if you do that, if you take on funding, there are obligations that come with that, no matter where you get the funding. So even if it's from somebody as relatively light touch as Enterprise Ireland, they will still require you to do certain things and you not to do certain things in exchange for that money, or as well as investing for shares. So this is a very fundamental concept that I recommend any founding team at least read the article, sit down and assess. Do you genuinely want to accelerate the growth of your business, let's say artificially accelerate the growth of your business at the expense of maintaining complete control over it? And the two are mutually exclusive. So if you are either of the personality type or just of the inclination, or if you want to maintain control for a certain period of time over your business, it's important to realize that, because once you take on third-party funding, particularly venture capital third-party funding, but also angel investment, and I'll go on to talk about that as well, you're down a path of no return, basically. So it's the hardest thing to fix. If you lean more towards wanting to maintain control over the business, and that means kind of making all the decisions on hiring, on exits, on who's CEO, on things like that, over the course of the business. So if you lean towards that, then taking external funding for shares is probably not for you. And there's nothing wrong with that at all. The worst position is to be wanting to maintain control of the business and then taking on external funding and then being surprised and annoyed and feel that you're kind of laboring under excessive restrictions, because that can't be fixed within that business. Basically, that's sort of it's a path of no return, like I say. So with that in mind, I'm not dissuading you from taking money. I'm just outlining the realities of it. So looking at where we can get money, because I know that for any startup, funding is a key element. So equity free means that you are not selling shares in exchange for the funding. So I would encourage everybody to mine this seam to its very last. And so obviously there's your own savings, which is fairly high risk, friends and family. As Rosemary said, the early Enterprise Ireland and local enterprise boards funding is extremely useful. There's a fair amount of kind of, let's call it like small portions of funding, like innovation grants and marketing grants and grants for your website and things like that can kind of be scooped up along the way. There's also stuff that it requires matching funding. So if you are considering using savings or getting money from friends and family, it's useful to investigate what's available as matching funding from either Enterprise Ireland or the LEOs as well. So at least you're kind of leveraging what money you're going to put in yourself, and in some cases doubling it from the LEOs. You can also look at tax credits and rebates. There's also an ability to get credit on tax paid for previous years. I have bank loans in there just because, you know, they exist. Whether or not they exist in reality for startups is a matter of some debate. But those kind of things are equity free, depending on your business. If your business can be kind of move forward appreciably with, you know, 5 grand, 20 grand, even up to 50 grand, depending on, you know, if you could get matching funding up to 50 grand in some cases, it's well worth investigating all of this and making sure you pick it up along the way. It's kind of like a video game, like a Super Mario Brothers. You sort of pick up all the mushrooms along the way here before you head into the equity-based funding, not least because once you've exited the early Enterprise Ireland world and head into what's known as the high potential startup world in Enterprise Ireland, HBSU, again, there's kind of no going back. You can't go back to the Leos and get more money once we've headed into HBSU. So although the kind of the human inclination would be to go as fast as you can, it's well worth taking the time to see what you can kind of scoop up at this level, because the later stage you are along the journey, as in the more you can prove about your business and have it on more solid footing, the greater the likelihood you'll be able to get funding. And if you do get funding, the better the terms will be if you have proved something along the way. So once we move on to kind of share-based funding, you can get investment, obviously, again, from friends and family. Enterprise Ireland will invest via either the Competitive Start Fund, which is kind of the next step on the Enterprise Ireland journey. That's CSF, Competitive Start Fund, which I actually view the Competitive Start Fund step as kind of the last step before that point of no return that I just talked about in terms of the build value, maintain control element. So even though you're taking on money from Enterprise Ireland and there are terms attaching to it, the terms are very, very light touch. And Enterprise Ireland, you know, they're not in the business of interfering with people doing business. So the restrictions that they place or the requirements that they have for CSF are really you know, very low level, and to my mind, kind of that's the last point, beyond which if you take further money for equity investment, you know, you're probably on the road of that you can't turn back. Some actually incubators, I don't actually, well, the places like the NDRC will take funding if you get a place on the NDRC programs, but they'll give you funding. Then there's angel investors and venture capital VC funding. It's important to note, I think it's important to note that where I've suggested that the line is drawn in terms of, let's say, the path of no return really is at Enterprise Ireland CSF level funding or CSF type funding. I think there can be a tendency for people to distinguish between angel investors and venture capital, and view angel investors as you know, lighter touch, less likely to interfere in the business, friendlier method of funding. And in some cases that can be true, but it would be a mistake to think that that is true in all cases. So from a kind of philosophical point of view, I would treat angel investors and venture capital as the same in terms of the fact that they will expect a return on their investment. You know, Enterprise Ireland won't be ringing you up going, you know, when can I exit? I'm ready to take my money back. Whereas I think that it is prudent to assume that angel investors, that I suppose the clue's in the name, the investor bit, are investing for a return. They're not all, they're certainly not all angelic, but they're not philanthropic, if you like. You know, there are philanthropists and there are angel investors who are motivated by things in addition to a return on investment, but it is only philanthropy that invests for the greater good, if you like. So I would approach angel investors and venture capital from a philosophical point of view as the same, even though I do know that people sometimes view them differently. Any questions, actually, just as we are early?
We do have a question, Siofra, here. So it's, do you know of any other examples of the incubators besides the NDRC?
There used to be loads. Do you, Rosemary? Or Siobhan?
Yeah, there isn't quite as many. I suppose the NDRC would have a good national coverage for the likes of accelerators and incubators. There are other pre-accelerators out there, but we can have a chat with that person offline and see if we can come up with something. Yeah.
There's I mean there's not as many as there used to be, that's for sure.
I suppose there's things like the New Frontiers program, which would be a kind of a pre-incubator program, but wouldn't be taking any equity at that point. But yeah, we can have a chat with that person about that.
And actually, just for the group, do definitely look at New Frontiers as well, because New Frontiers 3, the third phase of it, comes with money, and it is a very good program. I myself present at New Frontiers in various places, so it's but the people who are involved in the New Frontiers programs are very, very good and very company focused, and I mean they could give these master classes themselves, no problem. But then in particular verticals, there are supports available, like for example they're in food and things like that. There are particular supports available, but as you say, let's take that offline and we can give the information to the whole group. Okay, so should you raise equity finance? So let's say we decided, we want to build value, and we're absolutely sure that we want to build value, and we are fully aware of all the effects that may have on the business. The first question you really need to ask before you go down the long and sometimes winding, definitely hard road of raising money is to figure out if your business is suitable for raising money. Because again, much like if you lean towards maintaining control, that raising money is the wrong thing for you. If your business, as it is at the moment, or as it will be as you want to grow it, does not fit the profile for investment, the investment criteria, by which I mean the venture capital investment criteria, and again I'll talk about angels separately, because one of the, I suppose, maybe advantages and disadvantages with angels is that one cannot always be 100% sure of their motivation in terms of return. But does your business fit the profile of a business that is attractive to venture capital funding? Because if it isn't, again, you would be spending a lot of time and a lot of heartache going down a road that a path that kind of gets narrower and narrower and narrower. And by the time the energy that you would have to invest in order to attract funding could far better be spent building the business, or going for different grants, or looking for alternative sources of funding. So it takes an awful lot of effort to raise money, regardless of the business. But if your business does not fit the profile, then you're kind of on a hiding to nothing. So as I was, and Rosemary, I was glad to see your slide earlier on. You'll see this a lot. It is fact, basically. So what venture capital seed investors and beyond look for are businesses that are high growth or high potential. Now, high growth doesn't have to mean revenue, so for example, Twitter, but before Twitter had revenue, or certainly before Twitter was revenue positive, they had massive adoption. So showing growth by whatever metric is either available to you or certainly useful for you is extremely important. So Rosemary had mentioned I work for Drop Kitchen, and Drop is a very good example. That obviously Drop Kitchen makes they do a lot of integration now, but when I joined them, they were making an interactive scale, a wireless kitchen scales with a companion app on your phone that would interact with the scales and took you step by step through recipes to make lovely food. So they obviously could show sales of the actual unit itself, but what the VCs were actually interested in was growth in the the usage, so the adoption of using the app in conjunction with the scales. So even though that, like, increasing users of the scales wasn't actually increasing revenue, because the revenue came from the sales of the actual thing itself, but what they were interested in was, if somebody bought the thing itself, did they use it once a week, twice a week, less frequently? How engaged were they? And those were the sort of metrics for growth that were important to that business. So even without revenue, you can hopefully show, certainly if you've got something for people to use, you can show growth in usage or adoption or whatever the metric is for your business. And that's very important. And that can be important even apart from revenue and profitability and all that kind of stuff. High potential is also, high potential is also a requirement. And that really means that how big could this grow? So that's, you're getting into your total addressable market type discussions. So if I conquered all the market, what would that business look like? And what are the barriers towards conquering that particular market? So a market for, I don't know who's on the call, so usually I know the profile of people who are on the call, so I apologize if I'm about to use an example that's in your business, but like, if you make something that's very niche, you know, so the thing that popped into my mind was there was a crowd that was on one of the classes before, like a number of years ago, that made a smartwatch that was very geared towards orienteering. You know, so it had, you know, it was super accurate, and it had a super accurate compass, and all that, and it was very rugged and all the rest. Like, I mean, it was a lovely thing, but you kind of wonder, okay, like, if I sold this to everybody that wanted one of these, how much money could I make? You know, or how much profit or whatever. And there's another startup I know about that was selling particular equipment, or they're going to develop new equipment for yacht owners. And again, it's not to say, nobody would say that that's a bad idea. But from a venture capital investment perspective, you look at it and you go, okay, well, how many of these, you know, yacht widgets can I sell? And if the answer, you know, if you're not selling at a you know, very high price point, the answer could be, you know, well, not very many, you know, or like, there won't be necessarily a lot of revenue out of this if I'm selling them for $25 a piece. So that's, like I say, that's not to say that what we're talking about is a bad business or a bad idea or anything like that. But from a VC perspective, when they look at that, they may say, no, that it does not have the addressable market that we're looking for. As you move ahead, you need to be focused on the repeatability and scalability of what you're doing. So and even in the early stages, I think it's important to at least show that you're focusing on how you get to repeatability and scalability. So repeatability means basically, I do the following things in order to sell this widget, watch, software, whatever, to particular customers. And I have figured out that if I take the following steps, then I have an 80% chance of selling to particular customers. Therefore, if I do this thing over and over and over and over and over again, I will sell to X number of customers. So I know how to sell it. If I do this, I will be able to sell more. Ergo, if I have the money to do more of this, I will sell more of my widgets, you know, so that's the concept of repeatability. So repeatability is actually a really tricky thing to show. It's more than just kind of showing a marketing funnel. It is really showing a very clear route to market that you've been able to show has worked more than once. And what's important at very early stage is to show that you're thinking about this. So you're thinking about the route to market, and even saying things like, we tried this as a route to market and it didn't work, so we adjusted and we decided to do this differently, and that did work, so we're going to invest a bit more in that to see if that's the real solution. All of that will be music to the ears of a venture capital investor, if the other things are in place as well. So it shows them a level of maturity that that investors are looking for and can respect. Now, scalability is another kind of tricky one. Insofar as if I think about, okay, well, I have this pen, right? One of the favorites, the four colors. So I can buy this pen, let's say, for 50 cents, and I can sell it for 60 cents. And I know how to sell it. I go to the supermarkets and the stationery stores, and I put it up online and all the rest, and it's up there. And so I know how to sell it. It's repeatable. I suppose it's high potential insofar as there's a lot of people in the world that use pens. That's great, but if I sell, I can sell one pen for 60p that I've bought for 50p. If I sell 1 million pens, it's possible I might be able to buy them for 45p instead of 50p. But really, my unit economics hasn't changed. So if you think about the epitome of scalability is something like Microsoft Word or Microsoft Office. Even back, so it took a hell of a lot of development to develop the thing in the first place. So that needed to be funded. Then they started selling it, and that's fine. And then as they started to sell more of it, the incremental cost to create another copy of Office was very, very low. So there was a big pile of investment at the beginning, and then as things grew and as they sold more, the development cost would have been paid back, and then there was everything, further sales were at greater and greater levels of profit. So in the early days, you used to get a disc and heavy manuals, and it was shipped out, and that would have been a not a non-negligible cost. Now what you get, if you're lucky, you get a box, and then there's a little slip of paper in it that gives you a website address, or a little slip of paper that gives you a set of numbers that you type into a website that then you can download it. So every subsequent copy of Office that's sold has a greater and greater profit margin. And that's what scalability is. So my profit margin on my pen might only ever be, the 10 cent or 15 cent, but my profit margin on Microsoft Office, as we get more and more, as we sell more and more of them, the profit margin gets bigger and bigger, and that's what scalability is. And that's why in businesses like food, for example, can be quite tricky to show scalability, and that's why businesses like software and healthcare, health tech, and things like that are often the most attractive for venture capital funding. It's about scalability, really, is the key there. So it's very important to sit down and honestly appraise your business and see, is it fundable? Lots of people will give you advice about that. Certainly, it's always well worth chatting to venture capital investments, even at an early stage, even just to ask this question, and say, okay, this is what we're building. Is this type of thing attractive to you? And then listen to what they tell you, because certainly they don't have a dog in the fight if they're not invested yet. So even if it's bad news and they say, no, that's not attractive to us, and here's why, it's best to listen to that advice and either change the model or look for an alternative source of funding. Because persuading somebody, trying to persuade a VC investor that your business is something that it's not, is the path to tears as well. So more tears down that road as well. There's a lot of tears. There's a lot of tears on this journey. What VC companies are looking for is a growth, a shape of a growth curve, and people call it the hockey stick. So if you were building a business that you're going to maybe fund yourself or fund by revenue, so build something and sell it and then sell more and then, take the steps like that, your business could look like this growth curve, which actually looks a bit pathetic. I must change the axes on this, but if you look at it, that is a very healthy number. If we're looking at that sort of business, we're looking at, kind of 18 million within 10 years in revenue, which is an extraordinary achievement. But what VCs are looking for, you'll see from this curve, we don't go below zero. So we don't need investment as such. We're kind of paying as we go. Where the VC comes in is at this, to fund this dip, basically, to fund the company through additional spend in order to increase the growth curve on the way up. So they'll only invest in companies where it can be shown that more investment at this early stage will increase the likelihood of that growth curve going farther up. The kind of worst case scenario, the bad case scenario, is something like this, which is where the VC has funded the spend in anticipation of a growth curve that goes up very steeply, but actually the growth curve, although it goes up, it doesn't go up particularly steeply. Now we're still looking at a kind of a 24 or 25 million a year business here, but from a venture capital perspective, this is not a success. And again, that's really important to realize that you could build what is, objectively speaking, a very successful business, and yet a venture capital investor in your company may not be happy and may want some sort of suboptimal exit out of this situation. And that's because of the pressure on them to make returns of investment to the people that invest in VC funds as well. They're governed by very similar desires as they want from companies. So they have their limited partners and investees who are not kind of nameless, faceless people. Their pension funds and their high net worth individuals and things like that, and largely in Ireland, the government, or various sources of government funds and EU funds. But because so those funds invest in a variety of things, high risk, low risk, all sorts. And one of their high risk investments is into venture capital funds. So, and then seed venture capital funding that invest in seed companies, one of their riskiest investments is in startups. So you've got kind of people investing in small portions in risk all along the way. And in order for the VC funds to return the expected return, and indeed make it more likely to get another fund going to invest in more startups, they need to make a return on investment at the right level to their investees, and that level is is common knowledge as well. It's kind of 2 to 3 times the fund value within 10 to 12 years. And in order to do that, the venture capital funds need to invest in companies that they at least anticipate will have this very high growth curve. So even though on our green line here, we have created a relatively successful business, we have not created the investment profile that is enough for the venture capitals in order for the venture capital people to return the investment at the right rate to their investors. I see are there a few questions there?
Yeah, we do have a question, Siofra. It's just in relation to, you were talking a minute ago about all the different types of funding that are available to companies at that time, and kind of at all the different stages they would use an investment. So a question came in just in relation to where would you include crowdfunding on that list?
Crowdfunding, I'd include kind of, in terms of the control level, I would include crowdfunding in or around kind of the Enterprise Ireland CSF type. I have not myself been involved in any crowdfunding for shares.
Okay.
Now you can obviously do crowdfunding for product, which is a different thing, and you just give the product away or stickers or whatever, mentioning the credits or whatever. But in terms of crowdfunding for equity, there's generally, people do get shares, so you do have shareholders, additional shareholders to answer to. So I won't say that it has no effect on that kind of control, the considerations for control, but in terms of magnitude, let's say, if you do a crowdfunder, I don't think you're on the path to no return, put it that way.
Perfect, thank you. All the other questions are just complimenting the presentation that you're giving. So,
oh, are they? oh, go on. So, no. Right, now looking at kind of the type of investment instruments. So this is kind of part of a much longer presentation where I look at kind of investment instruments, but it is very important to kind of to see the basics of these, because this particular area is one where I find that people walk into a room and they feel like they should know this, and nobody kind of thinks to stop and say, you know, do you understand all this? You know, and you don't come out of the maternity hospital kind of with an innate knowledge of preference shares and whatnot, and nor should you. Lord knows, we only need to know it when we need to know it. So looking at the type of investment instruments, so you'll see that, you know, a variation of this sort of picture if you look on the internet about cap tables. So your capitalization table is basically your a list of either all of both your shareholders and the people who are entitled to shares. So the people who are entitled to shares might be share option holders or loan note holders, anything like that. So your cap table is basically shows who either has shares or is entitled to shares, and under what circumstances. So you might plug in under what circumstances would be kind of if somebody exercises their share options, or if a loan note converts into shares, and if there's a discount, or speaking of Enterprise Ireland, under their high potential startup investment, they come in as a kind of a different class of share that will convert under different circumstances. So what an investor wants to know is that if they invest X amount of money in your startup and your startup gets sold at some point in the future, given a sale price and a date at some time in the future, what return will they make on their investment? And in order to work that out, you need to know, is somebody going to be, you know, are there going to be more shares in play because somebody's exercised options or converted or whatever? So it is absolutely vital that you are rock solid, absolutely rock solid on your cap table. So who owns what, who's entitled to what are the terms under which they're entitled? The worst thing in the world is for an investor to start talking about investment and for basically the number of shares, which is, you know, their denominator, moves, you know, it gets changed. So because it's like, oh no, we forgot, we promised this person 1%, or we said that if this person joined us as a director, you know, they get 1%. So even though there's nothing formal there, but if you've had that conversation, it sort of needs to be in play here. So if there are errors on your cap table such that, you know, you've forgotten to list somebody that is entitled to shares, that will greatly shake the confidence of investors in basically anything else that you show them. So it's incredibly important, and here's the kicker as well, is that there's no one kind of logical person who's going to do this for you. You know, so I meet a lot of people who say, oh, well, you know, my accountant, well, surely my accountant is going to do that. And then they realize that their accountant isn't going to do that. And then they say, well, surely our lawyer is going to do that. And I can tell you now that lawyers break out in a rash when you start talking about Excel spreadsheets. You know, they really do. Like, I mean, it's like, you know, when, you know, those videos of when a cat sees a cucumber, you know, it's like, sorry, I just thought of that right now. But that's lawyers when they look at Excel spreadsheets. So it's not a good thing. It's not a good thing that there isn't this logical person like there is for so many other things that will kind of go, okay, I know I can sort out your cap table, stand aside, leave it with me. But even if you do find somebody who says, stand aside, leave it with me, I'll make it all okay, you as the founders of your businesses need to know how all of this works. You need to know the formulas that are in there, you need to know the numbers, you need to know why the levers are changing, and you know, what are the results of it. You absolutely need to know that. And in fairness, you know, it stands to reason, like if we're talking about taking on third-party funding for issuing shares, you know, the shares are your product in this case. So it stands to reason that you would be expected to know your product inside out. So that's kind of bad news, but unavoidable, and don't let anybody else tell you different. When investment happens, so looking at the mechanics of investment, you know, people hear the word dilution and they automatically think, oh, that's a really bad thing, we don't want dilution. But the journey of investment, taking on third-party funding for shares, for equity, means dilution. You know, so it is the natural consequence of deciding to take on additional funding for shares. So it's not a dirty word. It is the natural course of things. And what it means is that although founders start off with 100% of the business, they will end up with less than 100% of the business. So looking at kind of an ideal scenario, I don't know if you can see that or if my little thingy is blocking it, but anyway, so this assumes a 25% dilution per round. So after your seed round, the founders would have 75% of the shares. This is kind of like a very simple model now. This doesn't introduce Enterprise Ireland, it doesn't introduce angels or NDRC or anything like that. Then let's say we want to raise a bigger round at Series A. That then means, okay, our founders are down to 56%. That's still an extraordinarily good and clean result. Like I think that Aaron Levy, who's the founder of Box, when Box went public, he had something like 3% of the shares, which obviously sounds like a small number, but you know, 3% of a ginormo number when you're floating a company called like Box is an enormous return. You know, so it's a heck of a lot of money. So the percentages will change, you know, and that's to be expected as and when you take on investment. So if you're at Series B stage, which is kind of, you would expect a company to be profitable and basically growing in a very controlled manner and in a very repeatable manner. Basically, Series B investment comes on when the risk is fairly low, like the company's established and making money and everybody's happy. And then after that, you know, founders could be at 42%. Now, again, like the percentages are important in a return context, insofar as, you know, what percentage of the return am I going to get as a founder if we sold this? And venture capitalists themselves also care about what return the founders will get in an exit, believe it or not. Now, it's not because they care about you or anything necessarily. Although they might, who knows, who cares? But they want you to be motivated, because if they want you to stay with the business, then they want you motivated to stay with the business. And motivation comes from the expectation of a fairly large return if the company is sold or gets floated, because obviously we're all motivated by money. Nothing wrong with that. But so the point of this is really is to illustrate like an extremely kind of an example of an extremely smooth funding process. And even at the end of that, founders might end up with 42%, which would be an outstanding win. You know, it's like I say, I mentioned R&D at 3%. So a founding team with 42% is a significantly successful result. Now we're going to go on to our founding team now. So I might take a tiny break for questions before we start on that.
Siofra, before you do that, you might just answer this one. So what about ICO, so initial coin offering, as a form of investment?
Oh, I don't know. I don't know anything about those, actually.
I think it's quite an unregulated market, but no, that's okay.
Yeah.
And then
no.
just
Go on, sorry.
Sorry, no, I was just moving on to the next question. So just in terms of if you think an investor has seen a presentation, they're interested in your company and they want to know more about it. So you're having that initial meeting with the investor. What would you recommend taking to that meeting? Would it be business plan, financials?
No. So I would, if this is kind of like an initial chat, you've gotten a coffee with somebody, you know, you've met them at a conference or something and you're grabbing a coffee, I would have I'd have a very short deck, a kind of like 10 to 15 page deck, but what I would do is I would have a conversation, and then, you know, have slides of the deck ready to go if you want, particularly if you can show, like, for example, one of the things that was very strong with Drop Kitchen was the actual product itself, you know, and the slick design and all the rest. And they had a really nice kind of little animated thing showing, you know, how people would use it. And that's the kind of a perfect bite-sized thing to say, okay, yeah, this is what it does. And that's a real hook. Now, for financials at early, like, so we're talking early stage here, I certainly would have things like an illustration of the total addressable market, and you know, something of a financial plan, maybe a 3-year financial plan in your back pocket, but in a very, very simplified fashion. So sort of, you know, year 1, year 2, year 3, not in, you know, not a kind of a snapshot of an Excel spreadsheet. So you have it really to show that you've done the work, rather than sitting down in, you know, a pub or a meeting room or something and saying, oh no, let's just kind of delve into the bowels of our financials. So I think at early stage it's really about the hook for the product itself, hook for the product, the total addressable market, and then be able to show what your best guess of a financial plan would be. But you're not talking, certainly a VC, a venture capitalist, is not going to take a business plan, a 40-page business plan, or a 10-page business plan even. Now, I can't speak to angels. I would treat them the same way, but some angels might come from a finance background and might want things like investment memoranda and a financial plan and a business plan and things like that, in which case you're just going to have to do it. You'll find that a lot as well. Jesus. One thing you'll find is, like, for every deck that you do and for every kind of key performance indicator that you include or growth metric that you include as you know, in your model, you'll always make you know, there will always be another one that a different VC wants. It's like, oh yeah, like that, but can you show that to me in purple? You know, and then it's like, okay, all right, so we have to go back and do it in purple now. So be prepared for that. Be prepared for that. It'll be frustrating, but you just have to kind of go do it. So, I would assume low touch, high level detail, low touch, visually engaging, and then see if they want you to follow up. And certainly, you know, the answer to the question is, if if an angel asks you, oh, you know, do you have an investment memorandum or do you have a business plan? The answer is always yes, no matter what. Okay. Yes, and then go do it. Is that okay?
That's it on the questions. Yeah, thank you.
Okay, cool. Right, we'll introduce ourselves to our founding team, Piggy and Beaker. I'm not even going to apologize if there are people on the call who don't know who these people are. You're far too young and you should be watching more of the Muppet Show. Anyway, right, so let's say under total normal circumstances, we don't take on any investment at all. So we start the world with a 50-50 split between our two co-founders. They've got 100 shares each. Just, you know, that 100 could be 100 shares each, 1,000 shares each, 50,000 shares each. Doesn't matter. That doesn't matter. We're all about the percentages now in this world. So let's say Elmo comes in and he's loaded, as we all know, hiding his money in offshore accounts, and he wants to buy the company for 10 million. And that's a relatively simple, here, I'll get rid of this little camera thing. It's a relatively simple calculation. He buys the company for 10 million. Piggy and Beaker had offer with 5 million each, buy their yachts and live happily ever after. Happy days. Now, if we decide to take on investment, okay, so this could be from an angel investor, it could be from a VC. So this applies the same and will likely be something that an angel investor will look for, and a VC investor will definitely look for, which is to invest in preference shares. So I want to take a look at the effect on that, the effect of this investment on the potential returns for Piggy and Beaker, our founding team. Okay, so what a preference share means is that in the case that the company is sold or liquidated or goes public, whatever, if there is a return on investment to shareholders in any form, our investor gets to choose either to take their 25%, which they invested for, or their 250 grand. So depending on which is bigger, obviously, they will take either or. So that's why a preference share is usually referred to, you know, is usually talked about in terms of downside protection, which means that no matter what happens, assuming that the company is sold for greater than 250 grand, our investor will get at least 250 grand back. And that's the kind of protective layer. So if Elmo comes in and wants to buy the company for $1.5 million, then that's fine, insofar as our investor will pick their 25% and they get a return. They get 375k back. Happy days. That's a return of nearly 50%, is it? Yeah, 50%. Certainly if that's within a reasonable time frame, our Big Bird is delighted altogether. And then Big Bird gets to raise more funds from more LPs and pension funds and whatever to invest again, because he or she, I don't know if Big Bird is male or female, he or she has shown themselves to be adept and astute investors. Now, if things don't go according to plan necessarily, and Elmo comes in and wants to buy the company for 600 grand, that means that instead of taking their 25% return, Big Bird takes the 250k back. So Big Bird is not happy in this scenario because they've made zero return on their investment. So yes, they've gotten their 250 grand back, but they weren't doing this just to, you know, put money in a piggy bank. They wanted a return on investment. So even though they're getting more proportionately, and I will show that, than the founders, they're still pissed off, if you like. So looking at the 1.5 million scenario, we've got kind of the as expected result, which is that our investor gets 25% and our two co-founders get half of what's left, which happens to be 37.5%. So that's kind of as normal. That's what we would have expected at the time the investment went through. But for our 600K return, you can see that the 250 grand that Big Bird gets back represents, instead of representing 25% of the total proceeds, now represents over 40% of the total proceeds. And what gets reduced as a result? The co-founding team's return. Now, this is a very simple sum, but like, I mean, if you're, and it's a kind of average, small to average size seed round. Once you're talking about kind of million, 2 million, 5 million, 10 million investment, then suddenly you can see what's known as the preference stack get quite heavy on top of the founders. So if instead of the 250K, it's 5 million, 10 million, whatever, then suddenly the amount for which the company needs to be sold needs to be much larger in order to make up for the disproportionate impact of the preference shares. So that's an important concept to understand. There's a couple of things on that. One is and sometimes I get questions. I'm not going to anticipate it here, but sometimes I get questions with like, well, what can we not all have preference shares? And the answer to that is no, or, not, I mean, of course, in theory you can, but in reality, no. One of the reasons that an investor, or one of the conditions under which an investor will invest, is to get this downside protection for their investment. And it makes sense as well, logically, secondly, like, because you've gone to these people with your business plan or your deck or whatever, you've persuaded them to part with cash that they're expecting a return on. And in the case of angels, it could be like cash out of their own wallets. And you've said to them, my company is worth you investing 250 grand for 25%. So what you're saying to them is that my company is worth 1 million euro after you invest. Please give me money. And what's happening here is that the company has turned out not to be worth 1 million euro. Or indeed, if it was 1 million euro, you ran it into the ground and now it's only worth 500,000 euro. So by those sort of kind of, if you look at that from a kind of a moral or philosophical point of view, it makes a lot of sense to say, okay, well, the people who bear the brunt of that reduction in value are the people who tried to persuade me of it in the first place, i.e. the founding team. So that's a logic. That's the logic. Now, a preference share is the most standard investment mechanism that you'll see. So angel investors may invest for ordinary shares, particularly if they're getting tax relief on it. Crowdfunding, I would imagine, will be ordinary shares as well. That'll be up to the company to decide. And you're looking at, okay, well, what will be attractive to a crowdfunding audience? But for let's call them kind of experienced angels, and definitely for venture capital investors, they will always look for a preference like this at a bare minimum, So do not, this is normal, this is every day. This is one of the areas where you just kind of learn what it is and go, okay, that's going to be part of my life from here on, because the preference itself can change. It can get a lot more complex. It can be, you can have a 2x preference, for example, which would mean that instead of the 250 grand that Big Bird gets back on a liquidation or an exit, the Big Bird gets 500 grand back. Then you can have what's known as the double dip, which is a participating preference, which is that, so let's say we have a 2x participating pref. Now we're into the language that you hear in the pubs at Web Summit, often spoken by people who don't really know what they mean, but bear that in mind as well. But let's say we have a 2x participating pref. What that means basically is that Big Bird will get 500 grand back from their investment, and then they will convert into ordinary shares and then share 25% of the proceeds that are left as well. That's the double dip. So it's like you get money here and then you get more money there. And again, that's all of these mechanisms are to balance against valuations. So if you approach a venture capital company and say, oh no, we're not one of your 50 grand for 10% people. My startup was worth at least 5 million, and I'm looking to raise a seed round of 2.5 million. Now, assuming in the crazy world that would fly at all, which is it's a slim chance. The chance is not none, but assuming the sort of like my startup worth 5 million, and I'm going to raise 2.5, that makes it far more likely that you're going to see these relatively complex structures at the very beginning, because what the investor is doing, like, I mean, it'd be amazing that they invest at all, really, with that kind of attitude, but with that kind of model at such an early stage. But if they are, they're going to definitely make sure that they have protected themselves all over. So there's going to be multiple prefs, there's going to be double dips, there's going to be anti-dilution, there's going to be the whole 9 yards. And while that might be an acceptable price to pay, if you like, for getting your 2.5 million, the other thing that you need to realize is that the terms of the preference shares only kind of go one way. They only get more let's say VC friendly. So if you approach a venture capitalist for your Series A round, so let's say we take on 250 grand in seed money, and in 18 months time things have gone brilliantly, and we want to raise $1 million on a valuation, pre-money valuation of 4 million or something like that. So we're delighted with ourselves altogether. If we come to them with a cap table that looks like this, which is a very simple structure, it's far more likely that you will be inviting a kind of a more simple structure on the Series A round. Now, it's unlikely to be a 1x preference on a Series A round, but the complexity level that's added to it will be minimized. Whereas if you've taken on money at basically too high a valuation too early, that have all these kind of 2x double dip dividend carrying shares that you've issued, then the next investor is going to want that and then some more, some other stuff. So then, your cap table ends up looking very complicated. Your what's known as a waterfall, which shows who gets what after an exit, looks very complicated. The different ways that founders can be squeezed in terms of their percentages become more numerous, and basically, in order for the founders or any kind of normal people like employees and things like that to make any money, it requires you to sell the company for larger and larger valuations, which obviously becomes a very tricky thing to do. So any questions on that?
We do. We have two in here now. So the first one is, if an investor buys 20% worth of ordinary shares and the company then decides to dilute and raise more funding, does the initial investor who has the 20% have to agree to their shares being diluted?
So that depends on the terms of the original investment, basically. So what you're talking about there is well, two things. There's preemption and anti-dilution. So preemption means that and preemption is normal in company law. So what that means is that if any new shares are going to be sold to anybody, then those new shares need to be offered around to the existing shareholders first. So that is kind of, the standard template, Schedule A, Companies Act, whatever it's called now, in your constitution. Okay, so in that regard, in theory, everybody has to consent before you issue new shares. But in reality, what will happen is you'll have basically polled everybody, and we're like, okay, we're going to raise money. Everybody knows we're going to raise money, and then everybody will sign a waiver of preemption, and that will permit you to sell these new shares to that new person. Now, in the worst case scenario, let's say our investor has 20% shareholding and they do not want you to raise more money. Now you're going to be on a very sticky wicket with a venture capital investor in that regard, and I think it's safe to say that there'd be kind of zero chance that they wouldn't have closed that off in a shareholders agreement. But let's say it's an angel investor, and the angel investor doesn't have any kind of extra rights in a different contract to say, no, you can't do that. And they say, no, I don't want you to raise more money. Then what you do is you say, okay, well, I'm going to raise more money because, I have the shareholders' votes and consents to do it. And I'm going to raise €1 million. And you, Mr. or Mrs. Angel, who own 20% of the company, you have the opportunity to participate in that round, and you can buy 200 grand's worth of that million. So you give them the opportunity to follow their money. And then you basically sell 800 grand's worth of shares to the new investor. So that's kind of, that's your kind of worst case scenario. And so, assuming that you don't want to raise more money from the angel, going down the kind of route of doom and gloom, is that the angel investor could say, well, I don't have 200 grand, because who has 200 grand? And who has 200 grand to put into, one basket, one company. And that's when they get annoyed. And so that's part of it. We'll hopefully get on to it. Like that's why, like the initial discussion with your angel investor is so important, to align intentions in that regard. So you're saying, okay, I'm taking 50 grand from you, angel investor, thank you very much, or 250 grand or whatever for your 20%. Just so you know, like, we anticipate raising more money, Series A, Series B, whatever you're having yourself, IPO, the whole 9 yards. And that means we're all going to get diluted. Okay. Now you'll be given the chance to participate in those funding rounds, but after a certain stage, it's not going to be feasible unless you want to invest kind of $500,000 or $1 million into this company. So having that conversation is vital. But I've kind of gone through then the sort of what ifs. Now I talked about so anti-dilution. Yeah, no, I won't talk about anti-dilution. That's for the longer. Yeah. Well, there was a second question.
The second question is, what preference stack format raises a red flag for you as a business owner?
As a founder, so it kind of depends on what stage the business is at. So at seed stage, your ideal scenario is either everybody has ordinary shares, or you end up with this sort of preference stack, which is the 1x preference. Mm-hmm. That's the ideal world. The let's say things like 2x preference or 3x preference, which is kind of that the investor will get back 500 grand or 750 grand or whatever. That model, which is essentially just a multiple of what they invested, is kind of the next level of simplicity. So you're kind of going to, even though the amount kind of guaranteed to the investor is larger, the model is the same, the structure is the same, even though there's still more money that needs to go into the investor before it goes to the shareholders. Then you might have something like a 1x preference with a dividend, a 5% dividend per annum that's rolled up and then reinvested in the company when the next round happens. That's probably, having a dividend is probably preferable, and that would be, you would see terms like a cumulative preference share. Those are the kind of words that are used there. Mm-hmm. Cumulative means dividend, or denotes dividend. But when you're looking at kind of participating shares is when you would possibly expect that at Series A. Participating shares, though, a participating share denotes a misalignment in valuation expectations. So it's not used as a standard investment instrument. So if you're presented with a participating share as an offer, it means that there is a misalignment about valuation. And it could well be the founding team goes, okay, Grant, you know what? You're wrong. I'm right. This thing is worth 5 million. You don't know anything. Watch me go. Have your participation, whatever. Because as a company grows, like so let's take the example of that. Let's say we've also issued these shares here, Big Bird shares, the 250k as a participating preference. Okay, so our company here is worth 1 million when the angel invests. Let's say we sell the company in a year's time for 10 million. Okay, so what happens in this model then is that the angel investor takes off their 250k from the top and then goes in and gets 25% of the remainder. So really their overall return in terms of like percentage of the 10 million is like 25.3% or something, you know. So the ratio of the 250k to the larger sale price becomes smaller and smaller and smaller. So it really doesn't matter in the end, you know. But if at the edges where the valuation hasn't increased that much, that's when it has effect. But sorry, in terms of models to be wary of, certainly at seed stage, really there shouldn't be any participation, there shouldn't be any redeemable shares. That's the other one. So it's like cumulative, participating, redeemable, preference are kind of the four pillars. And you really, at seed stage, you really only want to be dealing with a straight preference, ideally.
Perfect. Thank you. I think that answers that question. Thanks, Siofra.
Okay, good stuff. Oh, okay. Looking at the terms to be expected. So this is kind of what not to lose your mind about, kind of thing. So don't be insulted if you see any of these terms. So look at what's important: the economics of the deal and the level of control that you're being asked to give up, right? So elements of the economics of the deal will be decided around how much you're raising at what valuation, what liquidation preference is in there. So this is my opinion. I'll preference that. Many of the things I say are unassailable fact, but this one is an opinion. Is that I think it is better to raise money at a lower valuation in exchange for a straight preference share than at a higher valuation in exchange for a participating preference share, for example. So it's very important. This is where the cap table comes in. Very important to kind of run through the numbers at different exit values and to see, okay, if we exit at this value, what does everybody get? At that value, what does everybody get? And also take into account the fact that if you take on money via a fairly complicated share instrument, it absolutely means that the next round and the next round and the next round will have that and more complexity. The size of the share option scheme, ESOP, employee share option scheme. So the share option scheme usually comes out of your pocket before it gets rolled into kind of the larger cap table. And then dividends, you know, is there a dividend involved? And they can mount up, you know, I mean, but they're things that you need to be familiar with, at least, because certainly when you get to the high potential startup phase, there are dividends to be grappled with. So all of these things go into the economics of the deal. The economics, so things pertinent to the economics of the deal when you get to exit are things like the drag along. So again, these are all kind of terms that you hear bandied around. Drag and tag. So drag along basically means that if an offer comes in for the company and X percentage of the shareholders want to take the offer, they can drag the other ones whether they like it or not. And depending on like in many shareholders agreements, as in many venture capital shareholders agreements, the drag will be capable of being triggered by the VC. And what the shareholder agreement will require is that the founders come along with the VC in order to drag remaining shareholders. And that's a, that's a thing, like, that is a thing. So, I mean, if you're all aligned in terms of investment timeframe and things like that, that's fine. But I suppose a drag is a fact of life. You won't see a venture capital term sheet without a drag of some description. So the question then becomes, what's the percentage that's required to operate the drag? And indeed, under normal company law, if 80% of the shareholders want to sell a company, they can force the other 20%. So it exists outside of our VC world anyway. Redemption is basically if at some stage the shareholder wants to turn in their shares and get their money back, or turn in their shares and get a return back, and that obviously has an effect on the returns to the other shareholders. Enterprise Ireland shares in HBSU are redeemable, but again, that's kind of a story for another day. So that's the economic side of things. The kind of management and control side of things would be you would expect to see. You wouldn't necessarily expect to see anti-dilution. Anti-dilution means that in our, let's take our example that Siobhan brought up as part of the question, that if an investor has 20% of the shares and we want to raise more money, anti-dilution, if we raised more money at a lower valuation than that the investor invested in, anti-dilution would mean that investor's 20% is maintained through the investment, even if they don't invest anymore. So, and obviously, so let's say we're selling 20% to a new investor, and the old investor maintains their 20%. Obviously, then the people who get squeezed are the founding teams, anybody who's not a VC, anybody who doesn't have that class of share. So anti-dilution, you would is another. It's not quite. It's not as kind of a formal a share right as, there isn't a name for it in terms of, the participating preference, cumulative, all that, but it is a right attached to a share that greatly affects kind of the economics of things as well, really. And it also signifies that if you see a share being issued as part of an investment, it also kind of signifies that misalignment of expectation in terms of valuation. So anti-dilution protects on the downside, so all these things protect on the downside. So if you see it, you kind of know that there's a disagreement as to how much the company is worth. In terms of control, then in a shareholders agreement, you would also expect to see a consent to sell, that the consent is required to sell the company. But look at practicality as well. Like, I mean, if you look at that from the other angle, and a question that I'm often asked is if an investor can force a sale of the company. And in some cases, after a certain window, it's usually about 5 years. It'll say this in the shareholders agreement, that it'll say that yes, the investor can then flood the board and appoint management consultants or financial consultants to sell the company. But in reality, how much is a company going to be worth if the founding team is not happy to be sold? So there's always this kind of pragmatic balancing of, yes, I see that it says that on paper, but let's look at the likelihood and the likely effect and the likely circumstances under which that might happen, and concentrate on that kind of pragmatic element. So if the founding team is valuable to the company, a VC is unlikely to be successful at selling it at a decent price. And if the founding team is not valuable to the company, you got a whole different set of problems. So that is beyond the scope of this discussion. Preemption is kind of what we talked about in terms of if somebody wants to follow their investment and maintain their percentage ownership. That again is very standard. A tag is also, like I say, you hear drag and tag. A tag is basically when if a founder wants to sell all or a portion of their shares, what the shareholder agreement tag section will say is that, okay, Mr. or Mrs. Founder, if you get an offer to from somebody to buy all your shares, you have to make it a condition of that offer that they buy all my shares too. So that's the tag. I'm tagging on to you. VC investors will certainly want board representation, and angel investors may want board representation. And I'd be, if you go down that route, I would definitely put in place the parameters under which they'll leave the board, basically. So as a company grows, they outgrow their investors, even, they're angels, they're VC investors, whatever, and it's a bit of a bitter pill to swallow. I mean, a big fish in the Irish investment pool that kind of gets elbowed out of the way to make room for somebody in from Andreessen Horowitz. It's logical to all the rest of us looking outside, but egos need to be thought of as well in that regard. Just as I think of it as well, one of the things I did develop, sponsored by Frontline Ventures, is the Frontline Startup Manual. And if you take a look at that, you can Google it or find it on the Frontline website. That has a sample non-executive director agreement, which I would recommend kind of, that it's all in Word, like you can use it for free and for nothing. So yeah, the board seats, then there's kind of board consents, what the board has to consent to, what information rights, like what information do you need to provide the investor, and that's very important. And then a shareholder agreement will also contain terms on founder vesting, which is basically that if you leave, it's usually like if you leave within a certain time period, if you as a founder leave within a certain time period, then a percentage of your shares are kind of forfeit, basically. That is to be expected, certainly to be expected from a venture capital investor. So don't be insulted by it. And that's definitely one of the ones that investors get very tetchy or get very nervous if that gets negotiated too hard, because the way that comes across is you're thinking about what happens when you leave. So why are you thinking about leaving? Are you not going to stay here forever? And it becomes a very difficult kind of philosophical point to argue. So unless there's kind of a very kind of specific set of circumstances around why you think there should be kind of more lenient founder vesting, by all means ask, but I wouldn't have it be the hill that you die on. I think I might have to skip ahead actually on a couple of these. So close your eyes, everybody, until we, because I really want to talk about angels. I kind of covered these anyway. Yeah. So looking at an angel, right? So the good thing about venture capital firms is that we know what they want. We know what they want. We know what they're expected to do. We know what their investors expect of them, and we know what they expect of us. Now, personality does come into it, but usually if you give a good return on investment to the venture capitalist and make them look important, they're going to be delighted. End of story. So there's less of that kind of personal involvement in the whole thing. Now, an angel investor, the trick is figuring out the motivations of your angel investor. So some people are all hat and no cowboy, all fur coat and no knickers. You'll meet them. You'll absolutely meet them. You'll meet people who call themselves angels, and they have absolutely no intention of actually investing into a company. Now, I will be very quick to say that HBAN is somebody who's a member of HBAN won't fall into this category, but you will meet other potential angels outside of that kind of structured framework that can suck up an awful lot of time and energy on your part, kind of reporting back and giving them updates and, kind of hoping for, will they make a decision? Will they invest? Whatever. We're sort of, I think we're a little bit shy about sitting down with somebody and saying, so, are you going to give me any money? But don't forget, like, that's why you're talking to them. You know, they may also be your aunt or your uncle or your aunt's golf partner or whatever. But in this context, we are having a conversation that could lead to investment. And so while, you know, you might want to practice the conversation, it is a conversation that you want to have, which is, you know, tell me, you know, why are you interested in investing in startups? What's your expectation? You know, what's your expectation on returns? What level of involvement do you think you'd want in the company? Things like that. And that person should have answers to all of those questions. Because a bad angel, like, if you take money from an angel who ends up kind of having a misaligned expectations, so they think you're going to be the next Facebook. Let's say you're a tech company, they don't know much about tech. You know, you meet people who think that every tech company is Facebook or Twitter or whatever, and they expect a 60x return within 5 years. And once they realize that, or if the property market crashes again, or XYZ happens and they want to get their money out, they can't, you know, there isn't, you know, we're not a bank. We don't take on money to mind it for a while. We've spent it 5 times over on, you know, beer fridges and QA engineers, you know. So and they can get annoyed about that, and an annoyed angel can be quite damaging, can be very damaging, let's face it. So assessing your angel dispassionately is very important, and it can be very useful to kind of talk to other people about kind of what's normal, what, you know, in terms of the angel interaction. And Ireland, Lord knows, certainly in Ireland anyway, is a very, very small place. So people will know who's legit, you know, who's on the level and who's not. I was going to say something there as well now about, no, it's gone. Anyway, so go through the getting to, oh yeah, sorry. There will also bear in mind that there will be a sunk cost somewhere, you know. So I'm not saying that every time you sit down with somebody who says they're an angel and the first thing you say is, you know, are you a real angel? Do you intend to invest? You know, you'll probably have to waste a bit of time talking to angels who won't invest, or VCs who won't invest, or whatever. But, you know, use that as a kind of a honing process. But what I'm talking here is about kind of getting very deeply involved with an angel where you haven't had the meaty conversation about, you know, what are your investment criteria, for example. So get to know them. Have they invested before? So many of these people knocking around haven't invested before at all, you know, and it's bananas, or they've made one investment in 3 years. It's like, you know, why are we talking to those people? You've got other people to talk about, and you've got product to build and market to penetrate. What do they expect? What money back do they expect, and when do they expect it, really? And even if they say, I expect 60 times my money back within 5 years, you can say, okay, I hear you. Here's how this is likely to happen, because they need to know as well. They need to know that if we're taking on more investment in the future, you know, their percentage will reduce. And in order to maintain their percentage, they'll need to follow their money. And, you know, they need to understand how the preference stack works and all of that, you know. So like we're talking, like, and it sounds like I'm kind of doing them down, and I'm not really. Well, I am some of them, but not all of them, certainly. Because I have great respect for angels. And the reason is that most of them are literally taking money out of their own pockets. You know, I mean, it's one thing to be gambling with somebody else's money, but this is, you know, money that they would have worked hard for and kind of are reaching into their wallets and giving you. So so even though we want them to invest, and even though we think that this is, you know, the greatest opportunity that's ever passed their eyes, I think we also owe it to them to kind of explain the risk that, you know, they may lose it all, and that's true. find out how, if they expect to be involved. An angel that expects to kind of like, oh yeah, well, I might do a day a week or whatever, I would run like the clappers away from them. Like you'll never shoehorn them out of the place if they genuinely want to be involved on a day-to-day basis. So if that is the case, I would, if you want to kind of set up some sort of advisor relationship. Now, you should never pay an angel as well. Never. Like the other one big red flag as well would be an angel wants to invest and they give you 50 grand or whatever, and then you retain them as a consultant for 5 grand a month for 12 months or whatever. That is an absolute red flag. Run away as fast as you can and tell everybody about them so they don't fall into the same trap. They need to be aware as well. Like, I mean, if you take money on from an angel, kind of, no matter how rich they are, really, they will have limited scope to follow their money, so they may be good for 50 grand or 75 grand or 100 grand, but they're not going to be leading your Series A investment. And I suppose that's kind of that's all part of kind of the honest conversation that you have with them as to either, basically, if they want to, ask them, do they have further funds to invest, and also explain to them that over the course of time we may be raising more additional money, and while certainly the intention is that they be able to participate and maintain the percentage, there may come a time where it's just too much, and that's the way of it, basically. Finally, this is finally, it's not finally, I know it's not finally, actually there's one more, but anyway, do beware of the philosophical objection. So when you've got a VC coming to you saying, here are your founder vesting terms, if you leave within a year you get nothing, I want a board seat, and we want to do this and this, we want to do all these things, and we want all these different share rights and all the rest. Take a look and figure out why they are doing it. So I think too often when people are faced with investment terms, they kind of think that it's like it's a what's the word, like it's an adversarial relationship, that it's sort of like, I want this from you, whereas in reality everything that you'll see in an investment proposal is about kind of either protecting or, in some cases, maximizing, either protecting the investment or maximizing the chances that they can influence a successful result. And founder vesting, for example, isn't because they don't want you to be happy. It's because, ironically, it's because they value you in the company, and the way they show their love is to have a big stick behind them and go, if you leave, I'm going to hit you on the head with a stick, rather than, if you stay, I'm going to give you a hug, kind of thing. So that's kind of, but like I say, beware of if you find your blood coming up, if you find your blood's up in terms of looking at some of the terms of investment, I would definitely take it away, have a chat about it, try and see it from the other point of view, and look at the likelihood and the effect of something happening, and then figure it out. I am going to run through this. I know I am going to run through this. After you take investment, this is vital. And I have seen people come very unstuck on this one. Look at what the investor expects from you in terms of information on a monthly basis. It could well be a different world order for everybody, because you may not be used to doing monthly management accounts or knowing your cash flow on a daily basis. And you will absolutely need to do that. And the sooner you get that in order, the better, because what you really don't want is, having done all your hard work to raise your money and, get the investors on board and build a relationship with them and convince them of the amazing potential of your idea, that within 3 months, you've absolutely ruined all that good work, because you can't tell them the very basics of your business. So the work is not over when you've raised the money. It is really just beginning. And that is
Brilliant.
that.
Thank you, Siofra. That was fantastic. I think everybody learned an awful lot. And I think the brilliant thing about you is you make it so accessible and so easily, because it's a jargon filled, tricky world. And when you're not coming from, if you've got a commercial background in a different area or a technical background in different area, it's really tricky for people to gather all the jargon, and the expectation is there to know everything. So really accessible way and bite-sized. So thanks so much for that. I'm never going to look at Mario Karts quite the same. I'm just going to be thinking.
I quite like that actually. Yeah. There's a few ones.
Constantly thinking about funding as we're picking up the mushrooms on the way around the track. So and obviously the Muppets as well. So thank you for that. There's one last question, and I'm going to ask you for a really brief answer because it's a good question. John is asking, can you recommend what percentage size the ESOP should be?
It grows over time, basically. I would say that kind of going into seed, or well, around seed stage, you'd be coming out of seed stage with about 10%. And ultimately at kind of post Series A, post Series B, it would go up to maybe 20%. 20% is kind of the acceptable upper limit. I've seen 25%. But I would say 10. I would say 10 until you find that you're running out of options.
Brilliant. Listen, we'll wrap it up because I know it's a course to one. Huge thanks to Siofra. Looking forward to having you back down for an in-person event.
Me too.
We'd be delighted. And thanks to everybody for coming on. We will send you out a link to the recording of this so you can have a look back and refresh your memories. I want to thank the team here in Southeast BIC. Thanks to Siobhan for managing the Q&A, etc. And we'll look forward to seeing you at our next event soon. Thanks so much.
Thank you very much. My pleasure.
Thanks, Siofra.